Goldman Sachs also had a study that 2/3 of companies have absorbed tariffs so far in corporate margins. Is it your expectation that at some point that will end and potentially result in weaker growth as consumers push back against higher prices?
I think it's going to be very company dependent. If the companies have the wiggle room in their margins to absorb, and if they have a price sensitive customer, they'll probably absorb. But I think we are seeing more and more companies, as Mike mentioned, Nike, Procter & Gamble, saying we have to raise prices. And some, like tomatoes and coffee, which kills me, are already going up. But like he mentioned, Ford as well, they're estimating they're going to have a $2 billion hit from tariffs this year. So it comes one way or the other. It's either going to be corporate margins, which all else equal is a drag on the stock market, or it's going to be in the consumer, which is a drag on the economy, which then feeds through to the stock market.
At least we do have egg prices coming down. Maybe that nets out with coffee to make your breakfast.
It's a big enough component, eggs.
There you go. I do want to talk about the fact of why we aren't seeing every company in every industry pass along those costs. I assume it's not out of the goodness of their hearts. I assume it's because you have kind of an exhausted consumer. We're talking about the pace of inflation slowing down, but after many years of these sorts of increases, we're at a very high overall level.
Yeah, I mean, Friday we have retail sales, so that'll be an interesting check on where the consumer stands right now. You know, we did have inventories built up before the tariffs took effect, and so they could use those inventories at lower prices. That's pushed back the hit to consumers from this. And I don't know this, but I would imagine within some companies, there's an element of if I raise prices and it gets reported in the media, I might be in the president's crosshairs. So that might be one reason that some are also reluctant to do too much too quickly.
It is such a good point, and perhaps part of the reason why this earnings season, you haven't really seen companies guide that way. But Rebecca, they've also been punished a lot if they do guide that way, or even if they miss a little bit. What do you just make of the volatility and reaction we've gotten to companies that have given negative or missed this earnings season?
I mean, the bar was so low for this earnings season that if you missed a low bar, something's really wrong. So if you beat the bar, you got rewarded for that, but not by huge amounts. You couldn't miss the bar. And one thing I'll just add, tangential but interesting, I'm seeing more and more companies knowing that analysts are using AI to scan their earnings and figure out how to trade it immediately. So the companies are now using AI to prepare their guidance to try to maximize the response by the analyst community. So we're in, it's a total separate thing from our conversation right now, but it is so cool to me that this is going on.
It's like a step closer, though, to just like AI giving earnings and AI reacting to earnings and just cutting out humans.
Just the robots talking back and forth to each other.
So a bit of an aside, but for people following AI out there, you can just put that in your notes to look at.
Yeah, definitely. Well, speaking of earnings calls, we had a great story on the Bloomberg terminal this morning about CEOs hardly talking about a recession this reporting season. Some interesting stats here. You have executives for companies listed in the S&P 500. They've so far mentioned a recession fewer than 300 times during second quarter earnings. That is the lowest going back to 2001. So at least we have one potential big uncertainty put to bed.
Again, I don't want to second guess why they're saying what they're saying, but if you run a big company and you know your share price is going to be affected by what you say and how you say it, why do you need to mention a recession in your earnings? You could say we have uncertainty or we see some downside risk. I will say the Conference Board quarterly CEO survey that just came out about a week ago showed 34% of CEOs planning to lay off workers in the next 12 months. That was the highest percentage since 2020. So they might not be seeing a recession, but they are planning on reducing their workforces because they have higher input costs, partly because of tariffs, because there is business uncertainty and a possibility of a recession. So they're starting to clamp down, and that's going to feed back through the consumer. If there are fewer jobs, there's less income to spend. So this all creates a feedback loop. And I think the more dovish members of the Fed, they're more focused on that. And then the hawks are saying, yeah, but wait a second, inflation's at 3.1.
How do you then balance a Fed that is going to cut and the one big beautiful bill starting early 2026, giving that additional fiscal boost versus some of the weakness that you're noting?
Yeah, I think David Kelly over at JP Morgan's done a nice job analyzing this, and there will be some really nice tax refunds coming in the spring of 2026 and some other goodies. The question is, what environment is that coming into? So maybe people get a tax refund, but if layoffs are continuing the way I just described, they might not be spending all that money unless they have to, right? Necessities rather than like to haves. So I agree, all else equal, it's a fiscal boost. The question is how much will be spent versus saved, and that'll depend on where we are next spring. And right, like this is not the easiest moment to be forecasting that, given that the tariff rates, the tariff timing changes by the day.
So, Rebecca, you rewind to yesterday, to the news that NVIDIA and AMD agreed to pay the U.S. government 15% of their revenue from some chip sales to China. Definitely caught a lot of people by surprise, unusual, unprecedented. Just some of the words used to describe this arrangement. How would you describe it?
Possibly illegal, and a little confusing, frankly, because if our main national security concern is AI and China, then we shouldn't be sending them any chips, although there's an argument that if we don't, they'll build their own. I think that's debatable. But then if our biggest worry is helping the U.S. with AI, why would we slow down NVIDIA and AMD by charging them anything? If we want to let innovation thrive, we should be supporting them, not putting a tax on what they sell. So it's hard for me to add up exactly what the thought process was on this one. So I agree with you. Unprecedented. I forget your second word.
Unusual.
Unusual. Yes. All of these things.
Well, how about this for another descriptor? And this is what the Wall Street Journal wrote yesterday, Greg, over there, saying the U.S. marches towards state capitalism with American characteristics, saying that we are almost mimicking some of the moves done by the Chinese Communist Party. Would you also agree with that characterization?
I mean, the Communist Party comment is obviously a bit provocative, but I think directionally, look, the stock market's near all-time high. It's being led by tech companies. No one wants to get out of a position when quickly, we don't know when, we could have super intelligence, and there could be a lot of returns that come on the back of that. At the same time, you know, businesses need certainty, right? Whether you're a tech company or any company. And when you have a president and a cabinet who seem to be making policy changes somewhat arbitrarily and very company specific, it's not capitalism, it's not laissez-faire, it's not a deregulatory government, it's a picking winners versus losers. And that's not giving certainty. And I think we do see that reflected in company surveys. Just this morning, the Small Business Confidence Survey, it went up in July on the back of the big, beautiful bill passing, but the uncertainty index also went up. And I think that's part and parcel of all the policy changes that we're seeing that are hard to predict. You want predictability. You want low vol in terms of policy, and we're the opposite of that right now. So I agree with Greg on that front. You shouldn't have winners versus losers. You should have certainty.
Yeah, well, that was a really interesting readout, the fact that, okay, maybe we feel a little bit better, those small businesses, but we're also still really uncertain. Just, again, when it comes to this specific situation with NVIDIA and AMD and the U.S. government, it does call into question what the Trump administration is trying to accomplish in this relationship. When you think about export controls on chips, originally it was about national security concerns, but this seems to be more about raising revenue.
Yes, and we do need revenue. And there's a question if the reciprocal tariffs, the Emergency Economic Powers Act tariffs, the IEEPA tariffs, are ruled illegal, which is probably not going to happen, but it could. In theory, the government has to repay all these companies. That revenue goes away. So the revenue question's a real one and something people should be thinking about. I think with China in particular, look, they want China to rebalance its economy more towards domestic consumption. That would help the trade deficit. They want to deal with forced tech transfer. They want them to buy more goods like U.S. soybeans. But there's also stories that are less discussed. They don't want much higher tariffs on China ahead of the holiday shopping season here in the United States. That's a good reason to postpone till November. And they don't want retaliation. We can't survive without Chinese rare earths. The U.S. imports 70% of its rare earths from China. There is no near-term supply substitute. We use them in everything from smartphones and TVs to missiles and submarines. So we can't afford to have China take that step towards us. And I think they know they have leverage. That's another reason I believe that we have paused this for another 90 days.
Hey, Rebecca, if I can just add another corporate executive to those being targeted by Trump, just to take a pause here, because we got a Truth Social from Donald Trump just now talking about CPI, talking about inflation, saying that tariffs aren't causing inflation, going on to say that David Solomon and Goldman Sachs refuse to give credit where credit is due. They made a bad prediction a long time ago. They are wrong about so much else. I think that David should go out and get himself a new economist, or maybe he ought to just focus on being a DJ and not bother running a major financial institution. Rebecca, I can only imagine that this refers to Jan Hatzius yesterday saying that U.S. consumers will bear the brunt of the tariff costs. So here you have, again, another CEO targeted by Trump. When you look at something like this, we've been talking about the strength of financials, the fact that regulation is going to come support them. Do we have to look differently at deregulation and the federal government aiding them hand? If Donald Trump, he was also going after JP Morgan and Brian Moynihan not that long ago, too. Does this change maybe the enthusiasm over that sector?
I don't think so, because I think it's pretty clear that this administration wants to reduce regulation on the financial sector. I mean, President Trump's family is supporting the financial sector personally. So I think this is more just one-off hits, venting maybe even. But no, I think, look, the financial sector is benefiting from the volatility. We saw the revenue from the trading desks. They're benefiting to date from a consumer that's still in decent shape. We'll see how that evolves going forward, though. And they've been benefiting, especially recently, from a little bit of a pickup finally in M&A. And deregulation can help them further. I don't think it's going to be a magic bullet, though. You know, there's this hope that if change regulations around capital requirements, for example, that suddenly banks will buy tons more treasuries and that'll keep the 10-year yield low and help the housing market. I think that's wishful thinking. So the deregulation, all else equal, is going to be helpful for that sector. I think a lot of that's probably in the price. And going forward, again, I don't think there are magic bullets with this. But yeah, I think the sniping and the Truth Social posts are more venting frustration than necessarily going after a certain bank. But look, I can't read the gentleman's mind. I'm not going to try.
Well, going back to that Jan Hatzius note that got him in hot water, it's really interesting, actually. It's what we were just talking about with Mike McKee. He says that, and him and his team, that is, consumers in the U.S. have absorbed an estimated 22% of tariff costs through June. American businesses have absorbed around 64% of those costs so far, but their share will fall to less than 10%, thus passing the burden on to consumers. So he's going after CEOs across industries. He's also going after Jerome Powell very hard just this morning on Truth Social, threatening to allow a major lawsuit against the Fed chair. I mean, in your estimation, we haven't seen this really spook the market in a big way so far. Do you think that changes?
I mean, if they actually try to fire Jerome Powell for cause and really move that forward, that could spook the market, certainly, because that would be a new, crossing a new red line. But look, the jobs market was soft enough that I think if the Fed wants to take out an insurance cut at its September meeting, it could justify that, and it has plenty of data to do so despite this inflation print. We saw the same thing happen in 1995. Inflation was running above target, the job market was okay, and they cut 75 basis points over about a year and a half period. Stock market loved it, went up, and it led the economy to stay strong for a couple more years, and then we hit a crisis. It's possible we see that movie play out again. I think the difference this time, though, is that inflation is significantly higher, right? 3.1 on core CPI is almost a whole point above where we were in 1995, and the tariffs make that position even worse. Plus, the Fed just got through a mistake with the pandemic inflation, and that's going to be top of mind. So I think we will get a cut in September. I think the market's priced in so much that unless we got some really surprising data between now and September, that cut's coming. But to get 3 cuts or even 100 cuts by the end of, in the next 12 months or so, you'd have to have the labor market really tank for that to happen. And obviously none of us want to see that, nor does the Fed.